Hello and welcome to Magicbricks Now. You are watching Property Hotline. I'm Kavita Krishnan. Our guest for today is Harsh Roongta. He's a chartered accountant and a SEBI registered investment advisor. And yes, we'll be answering all your home finance questions today. First question comes from Himanshu Gupta. He's written it on our website www.mbnow.in. Now, Himanshu took a home loan from Axis Bank. He wants to know about the documents he should collect after repaying the loan. He says that he doesn't have an acknowledgement that all the documents related to the title of the property are with the bank. First of all, Himanshu, congratulations, you've actually paid off your home loan. It's very rare that we get questions from people who've paid off their home loan. It's a great note to start the show on. Harsh?
Well, I think one of the things that he unfortunately has missed is keeping track of what documents he had given to the bank in the first place. So he will just have to depend on the photocopies that he probably has, make sure that the original documents that he receives back from the bank matches the photocopies. And if there is some document that his records show but the bank is not giving, that might be a problem. So that's one set. Title deeds, whatever he has given, he should get it back, originals. The two other big things is, one obviously is a no dues certificate saying the loan has been completely paid off, nothing else is due. Second, another no dues certificate, this time in favor of the Cooperative Housing Society, which would have given an NOC in the first place, saying no more dues are there and the lien may be marked out. Similarly, if there has been an insurance policy, etc., another no dues certificate. So essentially, title deeds back and no dues certificate to yourself, to the society, to the insurance company.
Now, tell me this, Harsh, if you'd bought the flat from the developer at a time when there was no housing society, even then does he need to get a no dues certificate and submit it to the society?
I think it would be a good idea, because when the developer would have transferred this to the society in the meanwhile, assuming, he would have given a record of the mortgages for which he has issued an NOC, and therefore it would be a good idea to get that NOC in favor of the society.
Right, so key takeaway over here, if you're taking a home loan, then ensure that you have a copy of every document that you're giving the bank. You file it and keep it safe somewhere. So 20 years down the line or 10 years down the line, as in when you've paid off your home loan, you know what documents you had given to the bank at that time, and you can ask the bank to give back all those documents. Otherwise, the ones that you need to essentially check that you get back from the bank is a no dues certificate and, of course, the title deeds to your property. Quick question before we move on, Harsh. Now, I believe the bank also has a time period within which it will return these documents to you, right? Because I remember paying off my home loan and the bank said if you do not come within a week, then the documents will go away and we will not be able to return the papers to you.
That is not correct, but typically the bank keeps it in a central place. When you pay off, they will give you a time window during which you have to come and collect it. And naturally, if you don't collect it from the branch, it will have to go back to the central registry. It will cost you money if you want to get it again. So the bank cannot retain the documents, but it will cost you money, and it is in your own.
It'll take more time.
Yes,
it'll take more time.
Absolutely.
Right. So that's another thing that you need to keep in mind. Ensure that you collect it from the bank within the time prescribed to you by the bank. Rajiv has called in from Bengaluru with a question. Rajiv, how can we help you?
Yeah, good evening to you. Well, my question is, just I'm 54 years old,
Okay.
gentleman, right, working with a big corporate. My CTC is around 60 lakhs.
Okay.
I want to have 60 lakhs of the loan, right? What do you suggest? Should I go for a reverse mortgage or a loan against the property?
Okay, let me get the numbers right. You have a 60 lakh rupee CTC and you want a 50 lakh rupee loan. Is that right?
Exactly.
Okay. So should he go for reverse mortgage or should he go for a loan against property? Rajiv, before I bring Harsh in over here, let me tell you, reverse mortgage is not a loan. It's very different from a loan. Harsh will fill you in on the details.
Rajiv, what will you use this loan for? What is the purpose?
I want to send my son to US.
Okay.
I need this money. Yeah.
Okay. So, I think you will be much, if you already own the home, if you already have a house that you own, obviously for a reverse mortgage you would have to own a house. it's far better for you. First of all, you're not eligible for a reverse mortgage. You need to be 60 years old to be eligible for a reverse mortgage. So it's only meant for senior citizens. One.
Okay, so
And two, you would be able to get a loan against property at much cheaper rates than a reverse mortgage, even if you were 60 years old, for example. Yes, Rajiv.
I have contacted already mypesa.com, your people already.
Right.
They have given me quite a lot of offers. That's
Right.
why I just wanted to know, how do I go about it,
So, as I said, you will be able to get it's actually not mypesa.com, it is apnapesa.com. But more importantly, you will be able to get a loan against property at about 10.25% or thereabouts. Or you could even look at an education loan, although that would be a little more expensive.
Harsh, can we just break down the reverse mortgage product? Because a lot of people call in asking whether they can use it to take a loan. But technically, it's not a loan. You don't get a one-time payment, right? It's spread out over months. It's like an EMI that the bank is paying you.
Absolutely. So the max reverse mortgage loan, even if you are a senior citizen staying in your own home, these are two conditions which is completely free from any charge. These are the three conditions that need to be satisfied for you to be eligible for a reverse mortgage loan. Maximum loan is 50 lakhs, of which lump sum payment can be a maximum of 12.5 lakhs. So, I mean, the lump sum payment is really meant to discharge some kind of, say, medical liabilities or something else. The balance amount you will typically be able to get as a monthly installment. It is the exact reverse of a home loan. In a home loan, you take a big loan and repay monthly. Here, the bank pays you monthly, and at the end of your life, after your death, either your heirs will pay it back to the bank with interest, the entire loan amount, or the bank will sell off the house and get its loan back, and if there is any surplus, it will give it to your heirs.
So that's technically how the reverse mortgage works. The reverse mortgage does not give you the reverse mortgage cannot be, don't mix it up with a loan. It is not a loan. What you'll get is a one-time lump sum payment, and after that you get a monthly income. So this is very handy for senior citizens who may not have a pension scheme, who may not have, funds set away for their retirement. But if they do have a property, then it's a great thing that you can actually opt for. Your property can work for you in your old age. So that's technically what the reverse mortgage does. Do not try to use it to take a loan. So the answer to Rajiv's question is he would be better off, going for a loan against property or an education loan, whichever works for him. Moving on, we have Yash who sent in a question through Facebook now. He says that he's in the process of signing an agreement with a developer and a bank. He's availing a loan of 35 lakh rupees for a tenure of 8 years. The bank is sanctioning 90% of the loan for him. Now, he wants to know if he should go for a fixed rate of interest or a floating rate of interest or a partly fixed or a loan where the interest rate is partly fixed for 2 years. What would you suggest?
I actually find the question very strange because I think fixed rate is an animal that exists only in the imagination of people. I mean, yes, there are fixed rate products. I think you will have to search with a torch to find out anybody who's taken it. Because, I mean, it's a real fixed rate product that remains fixed for the entire duration of the loan is way too expensive. It's about 12.25%. When a regular floating rate loan is at 9.35, 9.4, 9.5%, it does not make any sense for you to pay this 2.5% premium to get this false sense of security that your rate will remain fixed throughout the tenure. Plus, please remember, each of these fixed rate contracts have an escape clause which says that, if there are adverse money market conditions, even this so-called fixed rate can change. So it makes absolutely no sense. The second one, partly fixed, which means it stays fixed for 2 years, that typically comes at the same rate. Again, over the next 2 years, what are we expecting? I think we clearly not expecting rates to go up. We are expecting them either to stay same or to go down. In which case, why should it make any sense for you to fix it for 2 years? So to answer your question, go for the best floating rate that you can possibly get.
Go for the best floating rate that you can possibly get, and on the screen over there you can see the interest rates that are being offered by various banks. This is a rate at which banks are lending at the moment. Of course, this would change from case to case, but this is the basic on which they are working with, and most of them are averaging around 9.4, 9.5%, with 9.3% I think being the lowest interest rate that is on offer in the market at the moment. Next, we have a question that's come in from Rahul Gupta through email. Now, Rahul wants to buy a 1 BHK in Malad East for 75 lakh rupees. He earns 37,000 rupees a month. His brother earns 20,000 rupees a month. Now, Rahul wants to know how much loan can both of them avail jointly?
See, first of all, not every lender will allow two brothers to pool their income and become joint applicants, but a lot of them might allow. Some of them will allow. Most major lenders will probably allow. Assuming both of you are below 40 years, you have no other loans, but otherwise, say on credit cards or some loans in the past, you have had a good credit track record, then a good rule of the thumb is that the amount of home loan you can get is roughly 4 times your annual income. So you club both of your incomes, make it annual, multiply that by 4, that's roughly about 27 lakhs. So I think 27 lakhs is roughly the loan that you can expect, which means, and since you are looking at a property of 75 lakhs, that leaves a huge amount of down payment that you will have to fund from your own sources.
So that's what you're eligible for, a 27 lakh rupee loan. However, Harsh, before we move on, one other thing. Now, 4 times your income is what any bank would be willing to lend to you. What is the loan amount that you should ideally be taking as, basis your income? How much percentage of your income should actually go towards servicing that loan?
So 4 times was a sort of a rule of the thumb. There will be banks who might give them a little more, maybe 30 lakhs, maybe 32 lakhs. That's one. But to answer your question, Kavita, I think prudently, if you are, what I would say, the green zone is roughly about 40% of your net monthly income. If that's going in home loan, all loan installments, that I think should be fine. I think somewhere between 40 to 50% is what I would call the yellow zone. Anything above 50% would typically fall in the red zone.
Yeah, you'll then be leading a hand-to-mouth existence. So 40% of your net salary, that is the salary that you actually take home, what you get in your pocket, what you get in your bank account at the beginning of every month, is what should go as EMI. Only 40%. Anything more than that, and then you are getting into dangerous territory. Because God forbid, in case you don't have a job tomorrow, in case something happens, then you will have a huge mortgage on your head, and you will have to service that EMI, whether or not the salary comes through. So that is something all people who are in the market to take a loan need to look at. I can see that, Harsh, you want to come in. Go on. What do you want to say?
No, I want to say that 40 to 50% is I would not call it a completely unsafe zone. Especially if you are young and your income prospects are good, that is an acceptable zone. I think it's above 50% that you should worry.
Right. Next, we have a question that's come in on Twitter. Hormaz has written in, wants to know if it is mandatory to have a co-applicant while applying for a loan. Also, who can be a co-applicant for a loan? Harsh, answer that question, but I have one other question to add. What rights does a co-applicant have over that particular property?
So I think first, it's obviously not mandatory. I mean, if I'm single, if I'm not married, obviously from where will I get a co-applicant? Lenders typically like to have a co-applicant, and I will tell you the reason. The reason, if something happens to the main applicant, then there are cases where they don't know there is nobody else who's responsible for paying off the loan and taking back the title deeds. If there was a co-applicant, that person may or may not be the heir, but at least there is somebody responsible to whom the title deeds can be handed over if the loan is paid. And plus it exercises a calming sort of an influence over the main applicant to make sure the loan is paid.
So essentially, it's the banks way of getting some insurance. I'll get my money back, and that I will be able to hand over the property deeds to somebody.
Yeah.
That is why you need a co-applicant.
You need a co-applicant whose income is clubbed, in which case it is insurance as well, because two incomes are being clubbed. Sometimes you may have, for example, your parents who may be retired. So then you really need them for administrative convenience, or you might have a adult child who may not be earning much.
So who can be a co-applicant?
So typically a spouse is a natural co-applicant, and obviously if the spouse is earning, then the earnings can also be clubbed. Most lenders would allow parents to be co-applicants, especially for single people who are not yet married. Some of the major lenders would allow siblings to be co-applicants as well. And I think that more or less sums up the list of allowed co-applicants.
Okay, so that's the list of allowed co-applicants. Harsh, you have not yet answered my question. If I'm a co-applicant on a home loan, what rights do I have on the property? Do I have any rights?
In fact, more important than rights are obligations. I think a co-applicant is equally responsible for the loan, notwithstanding that, he is just a co-applicant. He's completely, so if the main applicant doesn't pay, the credit record of both the main applicant as well as the co-applicant will be affected. One. Rights are only those that you might have in the title deed. So there are cases where, say, the property is owned by a single person and the parent is a co-applicant, in which case the co-applicant has zero rights in the property, except that if the loan is fully paid off and the main applicant is not there, the title deeds may be handed over to the co-applicant.
So essentially, as a co-applicant, and there's something that is very important, especially when there are couples across the country taking joint home loans. Remember this, as a co-applicant, you only share the responsibility of the home loan. You do not necessarily have rights to the property. If you want rights to the property, if you want a share in the property, then you also need to be a co-owner, which means that your name has to be written in the agreement that you're signing with the developer, or in the sale deed that you're signing when you're buying property from the previous owner. So your name has to be there in those papers, in the property papers, and in the registration that you do. Only then do you have any right as an owner of the property. Otherwise, you just have the responsibility to service the loan that you're taking to buy that property, right? Harsh, I know you have something to say, but we have a caller waiting on the line. So let's go to the caller first. Surinder Bish has dialed in from Delhi. Surinder, how can we help you?
Yeah, good evening to you.
Good evening.
Yeah, actually, my question is, I am the owner of one house in unauthorized colony on general power of attorney.
Okay.
And I want to purchase a second home, move-in property on bank loan, and want to claim the whole interest paid on that property by giving it on rent. So my question is whether this home, which I am buying on bank loan, will be my first home, will be treated as first home or the second home? This is my question. And, it is based on the income tax department, what they will treat this as a first home or the second home. Because I think I can get only when it is called the second home.
Okay, so he's essentially talking about tax deductions that he can avail of. And Harsh, I believe that it is up to him to decide which is a self-occupied property, right?
So Vish, I think what you just mentioned is that this new house you're buying, you're going to give it out on rent, right?
Right.
Any property, even if you own only one property, first of all, income tax does not limit deductions based on the first property, second property, third property. If you have 100 properties, if you are lucky enough to have the wealth to be able to own 100 properties, and if each of those properties was bought on loan, then the interest payable on each of those loans is deductible. There is no restriction. I'm repeating, there is absolutely no restriction on the number of properties for which you can claim a deduction for interest. Now, as far as rental properties, if the property has been rented out, obviously the rental is taxable. Against that taxable rental, you will get a 30% standard deduction, and the entire interest without any limit will be deductible. Typically, rental tends to be about 2% of the property value. If the loan is roughly 70%, then at 10%, you're paying about 7% of the property value as the interest for the year. And invariably, that will result in a loss. That loss is completely adjustable, or it is completely settable off against your salary income or business income, or both, whichever you might have. So there is no restriction at all on claiming deduction. Quit worrying about whether it is first home, second home, or third home. There is no such concept in the Income Tax Act.
So essentially what you need to make very clear when you're filing a return is that whether the property is self-occupied, that is whether you're living in a property or whether you leased it out. Right, Surinder? I hope that answers your question.
No, can you actually my concern was my first home is an unauthorized colony, house in the unauthorized colony, which is on GPA. There is no bank loan on that. Nobody gives on loan on that property.
Right, Surinder.
So what are you doing? What are you doing with that property, Surinder?
No, currently I'm living in that property, but that property doesn't have a approval from the bank.
So good news. I mean, as far as the Income Tax Department is concerned, a house that you own on general power of attorney is treated as your house property. They don't really, the bank does care about your title. The Income Tax Department doesn't obviously care about your title. There is a specific provision that terms you as an owner of that property. But because you are living there, there is no tax on it. So that is completely free. There is no question of, if you have not taken a loan, there is no question of getting an interest deduction. So your first house completely free where you are staying. Second house, because you're going to give it out on rent, 70% of the rent minus the entire interest, that will be allowed to you as a deduction. If that is a loss, that can be set off against your salary.
Right, Surinder, hope that answers your question. Very simply put, the IT department does not care whether you have whether or not the title or whether the property is legal or illegal. What it is concerned with is getting the getting the tax on the transactions that you make, getting the tax on the incomes that you earn. So that's essentially the mandate of the Income Tax Department. Now, as far as your property is concerned, what the Income Tax Department wants to see is whether you live in that property. If you live in that property, there is no tax that you need to pay. However, if you have property that you rent out, you will have to pay income tax on it, but that can be set off in the form of deductions that you can avail on the home loan that you take, right? Moving on, we have a question that's come in from Caroline on Facebook. Now, Caroline wants to know the difference between EMI and pre-EMI. That's a very home loan 101 question. But Harsh, it is something that throws a lot of us, can you break it down for us?
So, pre-EMI, essentially when you buy an under construction property, the disbursement happens in stages. And at some point, the entire home loan gets disbursed, the house is ready, entire home loans get disbursed. Now, the typical manner in which the bank charges you is that when the construction is going on, and they are partially disbursing based on the stage of construction, then on whatever has been disbursed every month, you just pay the interest element. Now that in bank jargon is called pre-EMI, before your EMI starts. After the entire home loan is disbursed, you start what is called an EMI, equated monthly installment, that obviously consists of principal and interest. So this is the typical breakup of EMI or pre-EMI.
And Caroline, one thing that you need to know is that it is not mandatory that you opt for the pre-EMI scheme. You can actually tell the bank that you would rather pay EMI even when your property is under construction. So say if it takes 5 years for the home to be delivered, you've actually been paying off your principal regularly and you've been paying off quite a bit of your home loan, which would not be the case otherwise, because otherwise if you go for the pre-EMI scheme, you would only be paying off interest, and essentially it's just a very expensive home loan that you've taken. Right, Harsh?
Absolutely, yes.
Also, Harsh, if you could just weigh in on the tax deductions and how that plays out as far as EMI and pre-EMI goes.
So I think people have a misconception that if under construction property, if they pay by EMI, you will get tax deductions. you cannot get any deduction for interest or for principal if at the end of a financial year the property is still under construction. It does not matter whether the interest or principal has been paid as pre-EMI or EMI. It does not matter. The property's construction has to be completed as of March 31st of a year for you to become eligible for any deduction claim.
Okay, that's it. So that's your tax deductions also simplified. Next is the last query for the day, and Harsh, we have very little time, so let's finish this off as fast as possible. Jagan has written in through email. Now he says that he's taken a loan against property. He wants to know what are the IT benefits that he can avail. We've already answered it once, but here you go again.
Deductions under tax are available based on the purpose for which the loan has been used. It does not matter what the loan is called, what is the security you have given. So, if you have used the loan against property for education, higher education of yourself or your child, etc., you can get a deduction of the interest. If you have used the loan against property to acquire another property, again you can get a deduction for the interest. If you have used it for consumption, you won't be able to get a deduction for the interest.
Okay, and that's it on today's episode of Property Hotline. Thank you very much, Harsh, for coming in, answering all those questions. And if you have any queries related to real estate, do get in touch with us. This could be anything. It could be buying, selling, investing in property. It could be home finance like those we answered today. It could be taxes related to real estate, or it could be legal issues. We will get the country's top experts to answer each and every one of your questions. Thank you very much for tuning in. Keep watching Magicbricks Now.
You can watch live TV on our website mpnow.in. Find us on Facebook at facebook.com/magicbricksnow. And don't forget to click the like button. You can also follow us on Twitter at magicbricksnow. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/magicbricksnow.